Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Back in the heart of Times Square, circa 2019, where we founded Monday Minutes. 4 years in running. I am with my main man, my wingman, James Fitzgerald, U.S. Army veteran, Afghanistan and Iraq, helping me out today on the streets of New York, navigating through this very turbulent time. First and foremost, a big thank you to Fox Business, Maria Bartiromo, for including us again last week after the Fed meeting. Big thank you to CNBC and Bloomberg for including us in articles over the weekend as we try and navigate through some very, very tough waters right now. I've got some bullet points that I wrote down this morning. We're going to run through them as expeditiously as possible. First, tactical and practical. That's been our sentiment to start 2023. You need to be tactical, you need to be practical. These are very, very treacherous markets right now, and there are a lot of unknowns. We call them minefields. We saw coming out of the mark-to-market exposure that was brought on by central banks in 2022, now heading into 2023. Regional banks, still evolving here. Calmer waters over the last couple of days, certainly constructive, but we do think this is going to take time to play itself out. Certainly on the regulatory side, it's going to take a year to 2 years until we find some solid ground and footing in terms of what that market structure looks like. But certainly we do think there will be an impact with regard to the regional bank crisis and the real economy. Capital markets, ton of deal flow this morning, a lot of issues hitting the market, a lot of issues hitting the tape, which is very constructive. So it tells me that the markets are, despite the issues that we're seeing on the regional bank side, the markets are still open. When you look at the rate structure right now, obviously a very big disparity between where rates are pricing and what the Fed is signaling. Credit spreads have gone up, clearly in March, have come back down, remain choppy. But in the end, there is an opportunity here, we believe, on the issuer side with regard to the rate structure that we're seeing. Rate cuts. This is probably one of the key issues in the marketplace right now. We have certainly pushed back on the notion of rate cuts. The Fed, I think, is signaling pretty clear here. Unless something really systemic happens in the marketplace, we think the Fed is inclined to maybe not go too much higher than where we are right now, although I think we need to be open-minded given the inflationary data that we've seen and certainly the employment number that we got on Friday. But the Fed seems inclined to get in and around this range, maybe a little bit higher, and try and hold rates for as long as they possibly can. So unless there's something to project them from moving off that stance, they are trying really hard. And when you listen to Chair Jay Powell's presser, the separation of financial stability issues from monetary policy and the fight against inflation. And then on the ground this week, it's all about inflation. We're going back to CPI and PPI. CPI will obviously be front and center in terms of economic data this week. In terms of rate direction, we have favored certainly adding duration on any yield backups here. We're watching 2-year yields very closely. We've been adding in and around the 4.25 range, and that's played out very nicely. Duration has certainly played a part within the evolution of the regional banking crisis, but we also feel you can't really get too married to any one particular direction at this point, because the economy is still evolving, inflation is still evolving, and the employment numbers right now, front and center, have been stronger than expected. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.